Welcome back, dear students. This is chapter number 4. This is my third lecture for what we have started last time. Present worth analysis. We covered up to slide number 24 last time. This is what we covered, and we said that this chapter is about evaluation of a project using different methods. So I'll explain what are the different methods which are there to evaluate the projects. Last time we discussed about a method how we can evaluate a project, about how long will it take an investment to recover, right? So that method was payback period method. We already discussed it in last class. We saw there were some questions, we had a practice, and then I asked you to solve questions as well. So basically this is what we discussed on slide number 14 about project screening methods. One was payback period method, and under payback period method, one we have is a conventional payback method and a discounted payback method. In conventional payback method, when we have a uniform cash flow, we simply divide the initial investment by that one. Or if we have uneven cash flow, then we have to calculate the cumulative cash flow until we reach the positive cumulative cash flow, and then we had a discounted payback method. Now I'll just start today from net present value method from slide number, let me go back, slide number 25. This is what we are going to start today, about net present worth method. Now remember, purpose of all these methods is to calculate an equal amount. What is equivalent amount means what is at this point in time, what is the present value of outflows, means present value of all of our investment in year 0, right? And then what is the present value of all our cost and the present value of all our cost in year 0. This is what we calculate. Now this is just example here, that what we need to do is here that we have to calculate an equivalent net surplus at n equal to 0, right? This is what we have to calculate for a given interest rate. Now what is a net surplus means we calculate a present value of all cash outflows, right here, cash outflows. And then also we calculate a present value of all inflows. Outflows are our expenditures and annual expenses, and inflows are our benefits. If net surplus is positive, we accept the project. If it is negative, we reject the project. If we have multiple projects, multiple alternatives, so then which project to select? If there are 10 or 15 different projects or ideas by different engineers, then which one will we select? The one which has a highest or the largest net present worth, we should accept it. So I'll explain more with the next example, number 5.5, which talks about this tool company. A machine tool investment company, the Tiger Machine Tool Company, is considering to acquire a new metal cutting machines with initial investment of 76,000, you can see here, which is minus, and these are the benefits which we will get it over the project's 4-year life. They are given, and president of the company have asked you to evaluate the economic worth of this acquisition. The firm's rate, which is minimum acceptable rate of return, or interest rate, sometimes we call it in chapter 3 and 4, but here in chapter 5 we'll be calling it as minimum acceptable rate of return, MARR. This is 12% for this example, right? So it is a minimum acceptable rate of return, or sometimes we call it minimum attractive rate of return, right? So now we are going to evaluate this project based on this information. So, see, if we simply add these 4 cash flows and then compare with this one, it's not correct, because in engineering economics we said that the value of this amount at this amount is not same. We cannot simply add them because of time value. That the money we received in year 1 is not same as what we receive in year 2. So if we want to add all of them, all benefits, what we need to do is we have to take them back to year 0 by calculating a present value for all of them and then comparing this one. Then you will have a net amount. If it is positive, we accept the project. If it is negative, we reject the project. Now similarly, it is just same like chapter number 3. It is an uneven cash flow, so we have to calculate a present value of each of them one by one. Present value of this, present value of this, present value of this, present value of this, using a simple formula. So with this one, you can see here, this is just another notation written. These are all positive cash flows and these are our negative cash flows. So in order to compare, we have to calculate a present value of all of them separately. If we solve it, this one is right. So if you calculate it, what is the net present worth of this project? If you look at a solution on a book, let me stop it for a little while to see. I'll just coming back to our example. So if you calculate a present worth of this one using our formula, which is F equal to P times 1 plus I raised to power n, or P equal to F over 1 plus I raised to power n, that formula we use it and we can calculate a value of this cash flow. It is going to be 30,655 minus 76,000. This is the cash outflow at year 0, and this is the present value of all those future cash flows. You add it, we get 30,065. Since it has a positive cash flow, right, so this project is acceptable. Now similarly, we'll go to next exercise 5.1, but before I start, I'll pause a little bit for you to practice and check these numbers if they are correct. Yes, welcome back. I hope you solved it correctly. So this is how it should have been. This is the answer which was available as well. You can solve it and check it by yourself. What is the present worth of this project? Now I'll go to exercise 5.7 and 5.8. First I'll go for exercise 5.7. Yes, exercise 5.7. What is the present worth of the project which requires 130,000 investment now and receives 40,000 every year for 6 years at an interest rate of 14%? So again, this is very similar to what we have studied before. So what we will do is we will look at a cost, which is this one in year 0. This is minus 130,000 plus present value of this 40,000, which is every year for 6 years. So again, it is an annuity, P equal to A times that formula which we have used before. You can use that rule to calculate the present value of this annuity, and we'll have our net present worth for this project. You can solve it, you can practice by yourself as well. So this is how it will be. So present worth of this project will be minus 130,000 plus minus 130,000 is the cost, and then 40,000 is the present value of an annuity at 14% interest rate for 6 years. So this is how we'll have our P. So you can see here, this is the present value of cash flows, this is the present value of all costs. So if you add them, it is 25,000. Since it is positive, right? So we should accept this project. Now next question is 5.8. Yes. Now, sorry for a little delay. Larsen Manufacturing is considering purchasing a new injection molding machine for 250,000 to expand its production capacity. So this is the initial cost. It will cost an additional 20,000 to do the site preparation. So again, this is also minus 250 minus 20 in year 0. With the new injection molding machine installed, Larsen Manufacturing expect to increase its revenues by 90,000. Now this increase in revenue, this is a benefit which will come every year. What are the costs or outflows? Are this one, year 0 minus 250,000 and minus 20,000 for site preparation against this benefits. And the machine will be used for 5 years with an expected salvage value of 75,000. At an interest rate of 12%, would the purchase of injection molding machine be justified? Again, we have to see what are the costs in year 0 plus what are the present value of this cash flow, which is every year, and this salvage value, which is in year 5. So using a cash flow and using same techniques what we have discussed in chapter 3, we can calculate a present value. You can check your answer again, solve it. I'll wait for a minute. Yes, this is the answer of this question. Just let me show you, just a minute. Yes, so present value, is minus 250,000 minus 20,000 plus present value of this annuity, and then present value of this 75,000 in year 5. I'll show you. Yes, sorry for small graphic problems. It's okay. So this is salvage value in year 5. We need to bring it to year 0. This one annuity using P equal to A, that formula, to calculate present value of annuity or present value of equal payment, present value of a single payment in year 5. And then these are already in year 0. We don't have to calculate their present value. If you add all of them and then you can compare, then you can see here that answer will be 96,986.87. Since present worth is positive, so this project is acceptable. So you can solve these questions, check your answer, compare with what I have on the slides. Now I'll go to next exercise solution, which is similar to this one, 5.9. So you can, again, it is very similar. Just you have a cash flows, calculate a P. This is year 0, which is minus 35,600. These are unequal cash flows, so you calculate a present worth, which is 72,000, right? Yes, now we'll go to next question, which is 5.10. Again, it is very similar. You can check, solve it by yourself, and you can practice it. It is similar to what we have. We have initial cost is given, expected useful life of 35 years, salvage value is given, annual receipts 67,000, annual maintenance and administrative costs are 12,000 per year, and annual income taxes are 15,000. So if you want to calculate our net cash flows every year, it is, this one is inflows, the benefit, minus this cost every year, as well as income taxes every year. So if you have, you can see this one, 66,000 plus benefit minus 12,000 minus 15,000. This is what you will have your net cash flow each year, every year. This one in year 0, and this one is after 35 years, the salvage value. This is a one-time payment. So rate is 15%. Now the part A says, is this project justified at 15%? So what you can do is you can calculate a net present value at 15% and compare. If it is positive, then project is justified. Now they say the part B, the proposal has a net present worth of this one when 20% is used as an interest rate. Again, you do the same thing. Everything is same except change I to calculate the present worth of the project. And if this should be your answer, if this is the answer, then it means it is correct. Then you can look at part C, that as long as it is 15.93%, the project is acceptable. If we put it 16%, this project shows a net present worth of minus, which means this project should be rejected. So D, all of the are correct. All of these precedings are correct. So how to solve this question? We have to calculate a net present worth for part A, for part B, and for part C. This is how we solve this question. On next slide, you can look at it. The next slide. This is the solution of part A, part B, part C. Because at 15.93%, net present worth is 0, means that it has no profit, no loss. This project is not adding any value to the business, right? Or does not giving us any loss as well. So at 15.93%, our answer will be 0 approximately. It might be close to 0 or plus or minus more than this. It depends on your rounding of the numbers which you use in the formula. If you put it in the formula, it should be close to 0. So this is how you solve this question. So try to solve it again yourself. Very similar to what we solved before in chapter 3. It is exactly same. Next question, 5.12, is also similar. Beloit Company is a manufacturer of a mini donut machine makers. Early in 2015, a customer asked Beloit to quote a price for a custom designed donut machine to be delivered at this date. Once purchased, the customer intends to place this machine in January and we use it for 4 years. So the useful life is 4 years. Expected annual operating net cash flow is 120,000. So it is already given. We don't have to calculate. As compared to previous question, where we have to calculate the net cash flows. Here net cash flows are given. See, in this question we have to calculate. This was inflows and these were the two outflows which we have to calculate to get a net cash flow. But in this question it is given 120,000 is the net cash flow. Expected salvage value at the end of 4 years is not given, but how it is given? 10% of initial purchase price. Very important information. To expect a 15% required rate of return on investment, what would be the maximum amount that should be spent on purchasing the donut machine? So I'll pause for a little bit. You need to just think what should be the method, how we are going to decide. Yes, in this question, if you know that net present method says present worth equal to minus cost plus present value of all cash flows. But how much we must pay? Yes, so how we calculate a net present worth, I'll just explain here. Yes, if you know that it is net present worth is equal to cost, which is minus, let's say minus cost plus present value of all benefits. Now in this question it says the question which we are solving now, that what is the cost, at which cost we must purchase, the maximum amount we must pay for this one. So what is the maximum amount we must pay? We should not make a loss first of all, right? This is the amount, the minimum amount we must pay is where net present worth is 0, meaning we must pay an amount which tell us that if we replace this equation, right, that if I transfer this one to other side, this is just an equation, I'm just solving it. It's just I rearrange it. So this is the minimum amount we must pay, where cost of a machine equal to present value of all the benefits. This is how and what we should do in this question. When we go back to this question here, right? So what is the present value of all benefits, right? Now what are the cash outflows as well? We can see here what are the cash outflows, 120,000, and the salvage value. What is the present value of 120,000 and what is the present value of this one? Let's say purchase price is X, for example. What will be the salvage value? 10% of X, right? If I put it in this equation, let's say let's say cost is X. I want to rewrite the equation replacing cost as X equal to present value of all benefits. So present value of 120,000, which is per year, and plus present value of salvage value, which is yes. So this is our equation. Present value, salvage value. What is salvage value? Which is 10% of X, right? 0.10 or 10% of X. This is the salvage value. Whatever the purchase price, 10% of that one. So this is how we are going to solve this question. You can see here present worth by rearranging this equation, right? Minus x plus this 120,000 present value of annuity plus 10% of x. What is the present value of that one? We can calculate it and solve it for x. This is the amount the minimum amount we must pay to purchase this machine. Yes, in case if you don't remember the rule which we use here, I'll just share what we have done previously. This is what we have done in chapter number 3. These are the rules which we use. Remember, this is for a single payment, F equal to P or P equal to F. For salvage value, we use this rule to calculate P. And for annuity, this is the rule to calculate a present value of an annuity, the equal payment. This is the rule which we use to calculate this question. Present value of 120,000 is P multiplied by this one. This method we use it to calculate the present value of annuity. And for this one, which is salvage value, is 0.1 of x, right? This is basically f. 0.1 x is the f, and then this is the interest rate and I, and using this formula, this one we can calculate a P. We use this rule to calculate. Just using this one, just solve it again. You should have this number as the maximum amount we must pay. So I'm not solving more questions. What I want you to solve the question on your own. Try to practice these questions. Question number 13 is there, solution is there. Try to solve and have a practice. Number 14, it is there. You can solve this question as well. Question number 14 is similar in the book. 15, these questions, solution is there. You can have it, you can check it in the book. 17, and this is exercise 17 here is similar to our discounted payback period method as well. It is the same concept. We call it project balance, that after year 1 what is the balance of a project, which is same concept as discounted payback period method. This is the same method which we solve it already. For example, what is the balance of this project A after year 2 is positive 5,229. If you want to get rid of this project, you want to sell it to someone, this is the amount you must pay. Similarly, this is the project balance for project B. How it is calculated? Again, it's the same concept. It is the table is there. This is exactly same as discounted payback period method. Solution is here for 17 as well as 19. There are same concept, only some numbers were missing from the equation. Same concept. You have to find the missing numbers and then calculate and complete question number 19, 26, 41 and 45. So this is what all thing we have in chapter number 5. Try to practice all these questions, similar concepts. It is all about calculating a P, basically net present worth. This is what we call it. Not difficult. Without practice it will be difficult, so try to solve these questions. If you have any issue, anything you don't understand, send me an email, then I will reply. Okay, best of luck and hope to see you soon, inshallah. Bye.